Thank you. Good afternoon, ladies and gentlemen, and welcome to Snam third quarter and 9 months consolidated results presentation. In the third quarter, we saw a continuing recovery in Italian gas demand, which over the first 9 months of the year was up 8.1% to 52.3 BCM, mainly driven by the thermoelectric and industrial sectors. In this broadly supportive context, we deliver strong Q3 results, benefiting in particular from our continued focus on reducing operating costs and financial charges, both of which are progressing ahead of guidance. The liability management exercise in 2016 and the additional actions in 2017 reduced interest costs to 2.1%, which compares to 2.4% in full year 2016 and is below our original guidance of 2.2% for 2017. Meanwhile, in August and October, the regulator published 2 resolutions establishing the transition period for the transport and regasification businesses for 2018 and 2019. These 2 years of transition period are in continuity with the current framework, guaranteeing good visibility and stability to the operators. Let's now look at the headline figures for the first 9 months of 2017. CapEx was 683 million. This includes 607 million in the transport business, of which 44% is related to development of the network and is eligible to be incentivized. Revenues were 1.9% higher than last year, thanks to the increase in the asset base and the higher natural gas volumes. EBIT was up 3.3%, also benefiting from the delivery of the cost efficiency plan. Net income was up 18.2% year-on-year to 755 million, with interest cost, income from associate and fiscal charges all improving year-on-year. Net debt at the end of September was 11,156 million, thanks to the positive effect of some working capital items, mainly due to the effect of tariff-related items, net trade payables and net tax payables accrued in the period. Let's now look at our EBIT in greater detail. EBIT in 9 months was 1,063 million, up 34 million or 3.3% over the same period of the previous year. This reflects a 34 million increase in revenues driven by approximately 25 million euro due to the RAB increase, 22 referring to transport business and 3 to storage business, 11 million for higher transported gas, new balancing services for 5 million. This more than offset the standard tariff review of 5 million. Controllable fixed cost declined by 11 million. This is the overall outcome of 3 main effects. The 6 million of Italgas demerger synergies, which as already indicated before, are expected to reach around 10 million by year end, more than offset by the results of our efficiency program, which delivered 12 million of savings, of which 10 million in controllable fixed cost. A temporary reduction in gross labor cost that will be reabsorbed in Q4. Depreciation and amortization increased by 24 million, mainly due to capitalization of new assets during 2016. Other effects on EBIT are the absence of the one-off costs sustained in 2016 for the demerger and 7 million of lower capital losses, partially offset by some higher provisions in the period. Looking more closely at our cost-saving plan, in the first 9 months of the year, we have launched more than 85% of the circa 80 initiatives that were identified in March. With regards to the operations as part of our efficiency plan, we launched a project to integrate O&M, dispatching and commercial activities between our transport and storage business. We revised all the maintenance process with the objective of increasing standardization in asset management, increase efficiency in external cost, and improve the internal resource optimization. We have also created a single control room for dispatching activities with shared criteria for both the businesses. With regard to corporate, the 8 million in savings is mainly driven by reduction in external costs relating to corporate services and consultancy costs, as well as the renewal of some contracts for the operation and maintenance, as well as ICT infrastructure. These initiatives register good progress in the first 9 months of the year, and we have already reached 12 million of saving, well ahead of the guidance set in March at 10 million for the full year. Net profit for the 9 months was 755 million, up over 18% versus last year. This increase was driven by the positive performance of our operation just commented before, lower net interest expenses of 42 million euro, of which 29 million thanks to the reduction of the cost of debt driven by the liability management executed last year and the new issuances executed so far this year, and 13 million thanks to the lower average debt following the demerger of Italgas. Higher contribution from associates, partially due to temporary elements that will be reabsorbed by year-end, and partially due to a strong year-to-date 2017 performance. More in details, GCA was not included as the acquisition was completed in December 2016. It was a good performance of Italgas, better performance of TIGF and TAG to be partially reabsorbed by year-end, and lower cost for TAP due to the delay of some activities. Lower taxes due to the reduction in the corporate income tax rate, notwithstanding an higher earnings before tax. Tax rate for the period was around 26.3%. Thanks to the good results achieved so far, we confirm our net income guidance for the full year between 900 and 150 million euro. Let's now move to the update on our net debt structure and cost of debt optimization. In the first 9 months of the year, Snam issued 1.5 billion debt, of which 1 billion and 150 million were plain vanilla bonds, and the remainder was the convertible bond issued in the spring. These issuances have an average maturity of 6.4 years and an average cash cost of 0.76%. This does not include the 650 million issued in October as part of the recent bond buyback, which will be described later. Furthermore, in July, Snam signed a new 20 years EIB financing for 310 million euro at a very competitive 1.5% fixed cost. Our average cost of debt for the 9 months 2016 has been 2.1%, already achieving the guidance that we indicated at our first half call results. As a result to that breakdown, the fixed rate portion is 78%, in line with our guideline of 3/4 fixed floating for the year. The maturity profile is well spread over time, avoiding major concentration issues going forward, and our liquidity profile remains strong with 3.2 billion euro of undrawn committed credit lines. In October, S&P upgraded Snam to BBB+, following the upgrade of the Italian sovereign. Looking more closely at the liability management exercise completed after the close of the quarter, on 10th of October, Snam launched a tender offer on 8 of its outstanding bonds, maturing from January 2019 to January 2024. On the 25th of October, Snam successfully completed the transaction, acquiring 607 million worth of bond in nominal amount. The average residual maturity of bond-backed bonds was circa 4.4 years, with an average coupon of circa 2.4 years and an average yield of circa 3%. The deal, implying circa 660 million euro of cash spent, also including the accrued interest, was financed via the issuance of a new 10-year bond for 650 million euro, with a maturity in October 2027 and with a 1.375% coupon. As a result, we have further improved the average tenor of mid to long-term debt from 5.5 years as of the end of September to 5.9 years after the close of this exercise. This was Snam's third successful liability management exercise since 2015, and it highlights our proactive approach in leveraging the market environment to reduce our cost of funding. The effects of this exercise will further impact our cost of debt in 2018. Turning now to the dynamics driving our cash flow. Cash flow from operations for the period amounted to 1.6 billion euro, benefiting from 429 million positive impact from working capital movements. Of this, 152 million relates to taxes to be paid in Q4, 140 million is tariff-related items and includes 86 million for the overcharging and penalties for exceeding committed capacity, which will be reimbursed over the coming years, and 48 million euro due to the change in time lag between the cash-in of tariff-related items not yet paid to the equalization fund. Euro 43 million related to the cash-in of some receivables generated in the last month of 2016 after the introduction of the new balancing regime, and which will therefore reverse as a negative impact of last year. The reported cash flow from operations fully final net investment of 827 million euro, including further financial investments related to our participation in TAP of about 187 million euro. Following the share buyback activity of 210 million euro and the payment of the dividend, the increase in net debt was 110 million euro. This does not include the 217 million cash out for the acquisition of the Edison asset, which closed on October 13. With regard to net debt, our original guidance was 11.5 billion euro, excluding M&A activity and including the true-up of TAP, which was expected to offset the equity investment during the year. Today, we are including 217 million euro of M&A executed on the Edison asset and expecting the true-up to be in the first half of next year, which, all other things being equal, would have taken year net debt close to 12 billion. Thanks to the better operating cash flow and the residual benefit of working capital expected at year-end, we are guiding for a year-end close of 11.6 billion of net debt. Finally, an update on regulation. In August and in October, the regulator published two new resolutions regarding the transitory period 2018-2019 for the transport and regasification business. For both the business, the regulator introduced some changes. All the investments, including work in progress carried out in T-1, will be included in the RAB for the tariff determination of year T, substituting 1% additional return used to cover the regulatory time lag. Please note that the 1% additional return to cover the time lag is still applied to the investments carried out in the period 2014-2016. The current asset beta parameter was confirmed for 2018 and 2019. Investment-based incentive of 1% for transport and 1.5% for regasification for 12 years will be applied to new development capex entering into operation in 2018 and 2019. If these development capex for the transport business are starting after the end of this year, they will need to be backed by a supportive cost-benefit analysis. Operating cost, the unit commodity charge, CV, for the years 2018 and 2019 will be calculated considering a reference volume equal to 67.2 BCM. The regulator also confirmed that beyond the transitory period, the objective was to move to output-based regulation. This concludes our presentation. We'll now be pleased to take any question you may have.
Thank you. If you would like to ask a telephone question, you may press star 1 on your telephone keypad. Please ensure the mute function on your telephone is switched off to allow your signal to reach our equipment. Once again, please press star 1 on your telephone keypad to ask a question. Our first telephone question today comes from Enrico Bartoli from MainFirst. Please go ahead. Your line is open.
Hi, good afternoon. Thanks for taking my question. I have 3 of them. First of all, on strategy and further development in the future. Actually, you and DESFA started a consultation process regarding a possible increase in the transport capacity between Greece and Italy. Could you provide some details on, let's say, the project that could be involved in this aim, and particularly what the impact could be in theory on the capex plan of the company on the network in Italy. Then I have a question regarding your cost of debt. Thanks for providing many details about the bond issues and whatever, but could you provide us a guidance on the cost of debt that you expect for 2018 as a result of the liability management that you have just completed? And third one on results, if you can provide us a breakdown on the 133 million contribution from associates. And also you mentioned some impact that is going to be offset in the fourth quarter. If you can elaborate a bit more on this item. Thank you very much.
Thank you. So for the first question, what you refer to is a feasibility study. So it's not yet something that will have a concrete material effect. I mean, of course, we are monitoring any opportunity as a national TSO, and DESFA will do the same for his own part, on opportunity to support increased requirements for import capacity. But at this stage, we're simply talking about a feasibility study. Now, clearly, as we said in the past, and we have always reiterated, our presence in TAP underlines the importance of a new entry point into Italy from the southern corridor, and we only can confirm this underlying strong message. So we will be ready to support additional capacity as any opportunity may arise in the future. Moving to to our associate, the 133. What I mean by some effect that will be reabsorbed is because there has been a different phasing in some of our associates, particularly talking about the French and TAG around cost and revenues, which will be simply because of a different phasing of activities, which will be normalized by year end, which is why I'm saying that you shouldn't necessarily take this results and assume that the fourth quarter will be proportional, because some of these effects, and I'm talking about a few millions, so not something which is material, will be reabsorbed. To help you, I think, as we said in the first quarter call, roughly speaking, we expect our associate to be in the around 150 million by year end, and I think this number helps you understanding why we're saying that some of the effect that we have seen in the second and third quarter are actually to be judged temporary. Sorry, can you just repeat the second question that I missed? You were looking for the indication of cost of debt for next year?
Yeah.
I think
what you did.
This is not the venue for guidance on next year. What I can say is that thanks to the liability management exercise that we have just carried out, we think we start next year with around, call it 10 million euro of lower cost of debt because of this action. And then obviously we'll see where the market is when we will come out with a new guidance to provide a proper cost of debt guidance for 2018.
Thank you.
Thank you. We'll now take our next question from Harry Wyburd of Merrill Lynch. Please go ahead.
Hi, good afternoon, everybody. Two questions from me, please. First one's very high level. We've obviously seen a very big tightening in Italian bond yields in the last few weeks, which has given a nice boost to your share price. But I wondered from a pure fundamental earnings perspective, how do you see declining bond yields in Italy? Obviously, that reduces your financing costs, so your bond refinancing is cheaper. It also alters the formula from a regulatory perspective, given the allowed WACC review coming up. So if you could just give us whether you think that the tightening Italian bond yield is a net positive or negative for your earnings outlook. And then secondly, there's been obviously a big increase in focus on clean mobility in the last 6 months. You've got your compressed natural gas rollout ongoing. I wondered if you could give us an update on that, and also try and give us an idea of how much of that is aimed towards the commercial transport market, which is a market which has been identified as quite difficult to penetrate for electric vehicles. Thank you.
Thank you. Yes, of course, we have indirectly benefited from the upgrade of the Italian Republic rating, which obviously have pushed us up. However, we have always been trading well inside the sovereign yield. So in a way, the benefit on us has been slightly muted in this respect. Of course, this is a positive news in general vis-à-vis our cost of debt. As far as the implication on the WACC review, it's a function of where this will be going forward, not just looking at the spread, which is what has been impacted by the recent upgrade, but also more in general where rates will be going forward. And so it's, of course, the observation period has started. We'll need to see where the average ends by the end of third Q next year. And as I think is well known, when we are in a range above 150 bips, more or less, of spread between the BTP and the Bund, that carries a positive implication for our WACC review. Otherwise, we remain constant with where we are today. As it relates to the CNG, we are progressing with the contact and the agreements with a number of oil companies, and we are progressing our feasibility study in terms of identifying exactly where to connect these stations. Our focus so far is more on the private vehicle side of things, but of course we are also monitoring and exploring ways to support the development of gas in transport in general, and that also includes the way to support higher utilization of gas for commercial vehicles. This is an area in which we are clearly spending a lot of time, but the CNG initial initiative was for sure focused mainly to the private sectors. We are also looking in the context, as said before, of CNG to CLNG, which may also be more relevant for the commercial vehicle side.
Okay, thank you.
Thank you. Our next question today comes from Rui Diaz of UBS. Please go ahead.
Hi, good afternoon, everyone. Thank you for taking my questions. I have three quick ones. The first one is in terms of outlook for Q4 or for the full year, if you wish. Just if you could give us some guidance on whether you see net income for the year end, perhaps relative to the current guidance that you have. Secondly, do you think that the positive evolution that you have been recorded this year could result in upgrading the current dividend policy, or would you prefer to allocate these extra returns into net debt reduction? And the last question, just if you could give us an update on the interconnection project between France and Spain, please. Thank you very much.
Thank you. So for the net income, I think I provided during the presentation our guidance already, which is in line with what we said in July. So we confirm that our net income for year end will be between 900 and 150. As far as the dividend policy, I think we think, as we said before, our current dividend policy is well set. But then any consideration around dividend policy will be part of the new plan and our consideration on capital allocation. But we confirm that we think that our dividend policy is already attractive and remunerative, particularly consider the underlying EPS growth that the business is delivering. As far as the interconnection between Spain and France, the discussion between the relevant authorities are progressing. So we remain convinced that this is a key project. The EU remains convinced that this is a key project, and as you know, it was included among the project of common interest. We think this will remain the case. So we remain very convinced that this will happen, but we don't have further concrete updates to be shared with you at this point in time.
Okay, thank you.
Thank you. Our next question today comes from Javier Suarez of Mediobanca. Please go ahead.
Hello to everyone, and thank you for taking my question. I have three of them. The first one is on the guidance. You have reiterated guidance for the net income and also have guide for the net debt. Can you update us on the guidance in terms of capex and then consolidated RAB by the year end? Latest guidance would be appreciated. Then on cost cutting, I think that the company has surprised the market with over delivery on cost cutting. I think 12 million euros is above your previous full year target. Also, there are 3 million euros of a temporary effect related with personal expenses. So stripping out them, the underlying cost cut is 10 million euros, and the new guidance is 15 million euros by the year end. So can you explain us the bridge and the managerial actions that you are going to implement during the last quarter of the year to fill that gap of 5 million euros? And lastly, on the debt guidance, I think that you mentioned 11.6 billion euros by the year end. Can you explain us which is the working capital effect by the year end incorporated in that guidance? Thank you.
Okay, so let's start with the efficiency. I think we are progressing ahead of guidance with the initiatives that we have identified, and that's why we are now at 12 million after the 5.5 that we reported in the first half. We are confident that this trajectory will increase and continue. So we are confident that we will do better than 12 between now and year end, as this is a linear in some actions and on-off in others type of effect. I think if you are asking a number, I think we think we can add maybe 2 or 3 million to this 12, roughly speaking. But this is part of a bigger plan. So as we indicated, this was not a one-year type of effort. This is a multi-year type of effort. So we continue to work on actions to find more and accelerate the delivery on those that have already been identified. When it comes to the RAB guidance, I think we can guide towards a 19.8 billion of RAB at year end, roughly speaking, including the investments which we confirm in the 1 billion that we guided the market to before. So we are well on track on the capex as well, as we said before. On the net debt, of course we have some temporary effects. For example, the net tax payable, which will completely unwound in the 4Q. We have some working capital elements that contribute to the improved guidance in debt that we are giving you, mostly related to tariff and overcharging and penalties, which will remain with us until we have to reimburse them in either 2 or 4 years, as it is required by the norm. And so these are the reasons, if you want. I mean, there are some traditional commercial working capital effect that we continue to be confident that will be achieved between now and year end. That will guide circa 100 million of improvement. There are some items, as I just commented, in the overcharging and penalties. We continue to be positive on the fact that we'll retain the temporary the working capital related to time lag between when we are paid and when we cash in to the equalization fund. This equals approximately 100 million euro that we expect to retain for this year, and at some point will reverse. So these are the main events and items, if you wish, underlying our working capital movements.
Thank you.
Thank you. Our next questions come from Bartek Kubicki of Societe Generale. Please go ahead.
Hello, good afternoon. 2 very small and technical questions. First, regarding the financial costs, I understand in the 4th quarter you will book a 55 million euro extra financial cost related to the bond repurchase. This is correct, right? And I understand also the guidance assumes this. And second of all, regarding the M&As, during the last call you mentioned the pipeline should add around 18 million euros of EBITDA from next year on, including the synergies. Could you confirm it? And also regarding the associated the LNG investments, the 7.3% stake, could you give us a little bit of flavor how much into the top line it could contribute from next year on? Thank you very much.
Okay, so yes, I confirm that the 55 million is included in the numbers I gave before, and is also included in the net debt guidance that we just commented before. As far as the contribution from the Edison pipeline, I think what we said in July is that this company has today an EBITDA roughly in the 14 million euro. We are targeting a number of synergies that we think we will achieve by incorporating it into our perimeter. The transaction has just closed, so I think we wanted to give you a rough indication of what sort of contribution we expect once we've been able to achieve the synergies from this asset. Now, whether it will be a regime in 2018 or slightly in 2018 and 2019, we'll try to, as you've seen on other actions, to be fast in achieving these synergies, but it doesn't change the overall message that we gave. As far as the ALNG stake, as I said in July, this participation will be reported and registered in our accounts at cost and not at equity. This means that we will only be seeing in terms of flows the dividends which will be received, which will come up as income, if you wish, on our top line. We're talking about, as we said, we value this asset purely attributing a value to the existing contracts in place. I think I don't want at this stage to give you a number because I don't think we are giving this type of numbers so in advance on next year on our participants, but it's going to be a few millions of contributions, which of course there will be time and opportunity to comment in the new year once we will record the next results.
Thank you.
Thank you. As a reminder, please do press star 1 if you would like to ask a question. Our next questions today come from Stefano Gamberini of Equita. Please go ahead.
Good afternoon, everybody. Just a few questions. What is the size of the early retirement plan under discussion with the unions that you reported in the press release? The second, if you can elaborate a little bit more regarding this new project of an interconnection between Italy and Greece. What I mean is that an alternative to the TAP project or is an integration in the case of doubling of TAP project? And second, could this enter in your RAB or how this could be financed? And the last question regarding the level of the tax rate. What is the average tax rate that you expect on 2017, and if this is something sustainable also for 18 onwards?
Okay, so going to your questions in order. The early retirement is simply we have actioned, also discussing with the unions, the possible early retirement thanks to Article 4, which is part of one of, it's a very Italian specific, but we're talking about, sorry, can you hear me?
Yes, yes.
Okay, so we're talking about prepensionamenti, to say it in Italian, so that we clearly understand what we're talking about. So it's people close to retirement age, which thanks to a new incentive scheme that has been introduced by the government, can anticipate their retirement. So this is what we're talking about, nothing more and nothing less. It's part of the usual management actions that the management undertakes to manage its employees and also to the overall mix of our employees. Going back to the question of the Italian-Greece, we're talking about a standard open season type of exercise, so it's nothing more and nothing less of what is always envisioned. This is not alternative, it's just simply to the extent that there is, in addition to what is already envisioned, additional requirement of capacity, there may be additional opportunity for investment. It doesn't get into RAB. Obviously, what gets into RAB are the investments that will be carried out in Italy to the extent that new capacity requires additional investments. So it's nothing more than this. I think I commented on what we expect the rate, the tax rate to be, and I think we expected 2017 rate to be in the 2016-2017%. Again, I don't want to get into guidance for next year, but we should be a fairly stable type of rate going forward.
Just a final clarification, if I may, regarding a previous question. Regarding the level of debt, you said 11.6 billion euros at the year end versus the theoretical 12 billion, thanks to the impact of the working capital. what is the reassurance you expect in 2018 of this positive impact at the end of the working capital?
I think there are some elements, and in particular the time lag on the cash in to the equalization funds that may revert in 2018 or later, whenever it will be decided. So that's the 100 million that at some point may revert, fine. The other costs, the other items which relates to overcharges and penalties, as you know, we will need to pay them back in 2 or 4 years, as always is the case. So this is a fairly standard practice. So again, nothing in 2018 for those, but we will have other overcharging and penalties from prior years that may reverse. So the larger item that I think is worth keeping an eye on is this 100 million related to the equalization fund. All the rest are costs which frankly are part of the ongoing working capital movements that we have and that adjust from 1 year to the other, also depending on the way shippers behave and the volume of gas that we transport.
Many thanks.
Thank you. Our next questions today come from Maurice Choi of RBC. Please go ahead.
Thank you, and good afternoon. Just one question from me, and this goes back to one of your previous responses about your dividend policy. I guess your response there was you look at dividend policy as being correct as this point in time. Yet, of course, your net income, at least based on previous guidance, you've got net income of 4% CAGR. The market obviously believes that you can do better than that. So holding on to a DPS CAGR of 2.5% somewhat seem rather disjointed. So maybe if I could ask, does your response of holding on to your dividend policy stand, even though your EPS is clearly growing stronger than that? And the second follow-up to that is just more about, with the share price being so strong of late, how do you view your share buyback program today? Thank you.
Thank you. So going back to the dividend policy, maybe I have given the wrong message. I think that we have stated the policy for a period of year which we deemed to be, when we stated it, appropriate and at the level that combined with the EPS underlying growth that we expected, we deemed to be appropriate. And that's where we are today. So I think we are very pleased with the way the business is performing. I think this is not the time or the venue to comment the dividend policy. We think that overall our dividend policy combined with our underlying EPS growth is offer a good remuneration to shareholders. But again, this is a third quarter results call, and comments on capital allocation, including, of course, what is the right dividend policy, are not the third quarter type of results. So I'm sure we will have time to comment future dividend policy, not the current dividend policy, in the next year.
Great. Thank you very much.
On the buyback, I think, as we said before, the buyback for us was a way to offer scope for additional remuneration to shareholders as long as we felt that in terms of return, it was delivering a good returns. In terms of where we would have been buying back our stock. Of course, buying back our stock is a fantastic investment for us always, but from a purely financial standpoint, at these levels, probably it's something that wouldn't create huge value vis-a-vis, for example, investing in our own asset base, and we still have plenty of opportunities to do so, which is why you've seen that our buyback activity has not been carrying out over the past few weeks, and our average price of shares bought back remains 3.67%. One thing that is worth mentioning as is part of the net debt guidance that I gave earlier is that we are not planning to carry out additional buyback between now and year end. You will remember that at the March results presentation we guided to approximately 350 million worth of buyback since the commencement of the plan. We are slightly short than that as of now, but we are not planning to carry out more buyback between now and year end.
Thank you.
Thank you. Once again, if you would like to ask a question, please do press star 1 on your telephone keypad. We'll take our next questions from Olivier van Dusseler of Exane. Please go ahead.
Yes, good afternoon. Thank you very much for taking my questions as well. I would just have one remaining. It's just coming back to your net profit guidance for the full year 2017. So you come back to the 900 to 950 million, but given that you are ahead of expectations on your cost of debt and also on your cost savings, would it be fair to say that you are most likely to end up at the very high end of that range?
We would have said that we are likely to get to 950. No, I think we remain convinced of what we are telling you. We think we want to deliver on what we say, and I think, of course, we'll try to do our best to get to a higher end of it. But I think the message that you should take from today is that we remain convinced that our appropriate guidance is between 900 and 950, as we said in July.
Okay, thank you very much.
Thank you. As there are no further questions in the queue, I'd now like to hand the call back to Alessandra Pacini for any additional or closing remarks. Thank you.
Thank you. No, I would just want to thank you all for the time and the attention and all your questions, and see you at the next results call.